We have a very interesting session here on making the tough decisions in reforming global finance. And I think after the last few years, nobody can doubt that we really do need to make some very, very tough decisions. What we will be discussing today was really how do we know what tough decisions we need to make? Do we actually know what they are? Or are we still running around like headless chickens trying to find a solution? Do we have the ability to agree on what those decisions should be? And if we do have that ability, do we have the capacity actually to implement them? And most important of all, I think, do these various decisions actually fit together, or do they contradict each other? Are we trying to create a global financial system with a global set of rules when we have different countries at very, very different stages of development? And we have a panel here of people, I think, who are quite used to making very tough decisions. And they're going to talk about this. First of all, each panelist will talk for about 3 minutes, a very brief overview about what they see the decisions ahead and how to implement them. Then we will have a discussion, which I will moderate. Then I will try and bring in the audience to ask some more questions. And today we have a very distinguished collection both of bankers, practitioners, and people involved in international politics. Antoncic, the Minister of Finance. Forgive my pronunciation, I'm British. We're not taught anything to do with foreign languages. Andrey, Kostin, the President of VTB Bank. Michael Corbat, the CEO of Citigroup. Michael Andrew, the Chairman of KPMG. Frédéric Adair, the CEO of Société Générale. Ksenia Yudeva, the head Sherpa for the G20. Madelyn and Antoncic, who's from the World Bank. Sorry, I've got you wrong. And then Thomson, he's very kindly said that I only need to ask him by his first name, so that saves me one embarrassment. The Finance Minister from Singapore, and Chrystia Freeland, who's just literally got off the plane to be here. So I would ask you to talk each in turn for 3 minutes to lay out your general perspective on what's happening in the world of global finance, the threats, the risks, the tough decisions we need to make. Then we'll try and move on to a discussion session. Thank you. Anton at the end. Minister.
Добрый день, уважаемые коллеги.
Good afternoon, dear colleagues. I will speak Russian. Financial regulation issues are a key topic of G20, and many meetings of ministers from G20 usually touch upon financial regulation issues. And among the topics discussed, there's the coordination of countries in financial regulation issues, because without a common platform for such financial regulation, without achieving common parameters to evaluate the performance of financial institutions, it's impossible to estimate the effectiveness of this area. And this year, we've reached the institutionalization of the financial regulation system. We've received a status with FSB to improve the financial regulation and systematically rearrange this regulation across all countries. Discussions about separate regulation of the banking sector, particularly banks that dominate in the sector, the so-called too big to fail. What shall we do with banks that occupy key positions in the sector? What specific requirements to these banks to apply, how they impact the entire banking system. You know, there's 28 such lending institutions that are proposed for special control, special supervision. Undoubtedly, what we're talking about here is stricter requirements to the work of lending institutions. There are different opinions about this. A number of bankers are saying that in an environment of declining, slowing economic growth, Basel III should not be expedited, but the financial departments of G20 countries is that the reliability, stability of the banking system is a priority today. We need to continue the plans towards Basel III, and the Russian Federation follows these plans very carefully. We are now moving our banks to the Basel III system. A lot is being discussed about rating agencies. It's no secret that the objectivity of rating agencies impacts significantly the evaluation and performance of financial companies, real sector businesses, sovereign ratings. How objective are the rating agencies in estimating company performance? It depends a lot on the confidence to countries and individual companies in the financial sector. So it's about the objectivity of such an evaluation. The trend here is that maybe we should not establish our own local rating agencies, as was suggested in a number of occasions, but analyze the efficiency and effectiveness of existing rating agencies, how objective, how fair their evaluations are. This can be done sometime later. There's an evaluation sometime later. You can look at it and say whether it was fair, whether it was impartial and objective. So this is an area for us to move, and this is where we believe there is room for improvement in the objectivity of such agencies. As regards the Russian Federation, financial regulation is an area where we're anticipating a number of measures. We are setting up a unique central regulator, the central bank, which will have special authorities, will be regulated. And in regulating the banking sector, insurance companies, pension funds, it's all interrelated. And establishing such a regulator will help us improve the supervision and development of the legal framework for all the participants in the financial market. Today, financial regulation is key to investor confidence to individual countries. That is why we pay particular attention to this and hope that an improved financial regulation in Russia will help us attract more investors to our markets. More investors will trust our policy, and we believe that one of the key objectives in attracting investment is to streamline financial tools and financial regulation. Thank you.
Andrey, Kostin, 3 minutes.
Thank you very much. I will follow Mr. Silvanov, maybe subject, but he presented the G20 government view. I am, well, not opposite side, but different side, representing a business community and banking community of G20. As you know, probably then since 2010, there's a mechanism of B20, so-called business 20 is developing, and at this stage, I have the honor to chair the so-called finance task force, and we are now drafting some proposals to be included in the final documents of G20 meeting, which will be held here in St. Petersburg in early September. And we just this morning had a very extensive discussions on priorities for financial sector, and we approved a certain action plan which includes 3 major items. First of all, that's financial regulations. Mr. Siluanov was telling about this. I don't think that today bankers are actually against Basel III. I think we accepted it as a, but probably partly as an unavoidable evil. On the other hand, we understand that there is a need for improved and better regulations. On the other hand, we're telling the government that, look, we introduced now Basel III, let's review the situation, let's say in 6 months' time, and see what are the consequences of Basel III. Definitely, the banking business will become more expensive, it will require more capital, and as a result, that inevitably will affect the ability of banks to lend money to the economy. And the focus now, as we all understand, of the G20 is also on the economic growth, as well as of the Russian government. So the government expects us to lend more and cheaper money, and how it coincides with tougher regulations, one should examine, maybe not now, maybe at a later stage, and to see what kind of the room for maneuver we have in this area. The second, what we call is financial inclusion. What we see now, that in spite of the fact of the very soft monetary policy in, let's say, European countries, in America, we still have the problem of the access, particularly of SMEs, to the financial resources. And the set of measures taken by the government might ease this access and make the resources, financial resources, acceptable, or access to SMEs and other enterprises. And the third subject, which we put on our recommendation list, is the financial market infrastructure. We would like to build such infrastructure that would be more crisis resistant. Particularly, we're talking about emerging market and more transparent. I think that's a vital for, let's say, Russia. We now only trying to create our local stock market, for example. And recently, VTB was the first bank to manage to play $3.5 billion local shares, which was quite unique for Russian stock market, as most of our placement had been taking place in London or New York. But the potential risk of having a weak local markets in emerging market economy particularly adds to the global risk which exists in the financial system. Thank you.
Michael Corbat, Chief Executive Officer of Citigroup.
Thank you very much. I appreciate the opportunity to speak with you today. A few things I'd recognize is, one is I think that the world we're living in today remains a challenging place, economically, politically, and from a regulatory perspective. We're in a world where oftentimes the major secular themes or trends of globalization, as an example, are at odds with the way that regulatory reform is actually progressing. And as a company, we are very supportive of regulatory reform. We think it's necessary to make sure that we restore the credibility with our investors, with our customers and clients, with our regulators and all of our constituents. And as a company, we've been very supportive in the U.S. of the implementation of Dodd-Frank, which I'll talk more about, and we've been very supportive and in fact embraced and operating our business today on the model of Basel III, both from a capital perspective, where we've made public pronouncements that by year end we should and will be operating at or above 10% against Basel III standards, as well as the liquidity coverage ratio, which we're already operating at or in excess of. And one thing as I travel Europe that surprises me is oftentimes the degrees of skepticism or doubt that's placed around the significant U.S. banks' embodiment or moving towards Basel III. And certainly when you look at our perspective, we've made public pronouncements, as I know the other large U.S. financial institutions have in terms of their embrace of Basel III. We're a company that comes to work in over 100 countries every day. So the complexity of regulation and regulatory reform is critical to what we do. And I think, as Andrey mentioned, it's critical to the business environment, that we need a level playing field. We need harmonization of regulation. We need clarity of regulation. And I think one of the big challenges I think we face as an institution, but I think we face as an industry today, is that we have many regulators, many politicians, for many good reasons, pushing regulation. Oftentimes the things that they're trying to solve for are very similar, but they're taking very different approaches, and it creates conflict not just as we go cross-border, but oftentimes within same countries we have different regulatory branches or authorities seeking to solve problems within their own countries from different perspectives. So I think as an industry, as a global economy, we need clarity, we need finality, and we need that harmonization. We still in many cases have rules that are still being written. We have many rules that are yet to be finalized, and we have regulators who aren't necessarily communicating as well as we'd like to see them. And in there, it's challenging to be able to run a financial institution without having either the clarity or finality of rules. But again, the rules, the reform are essential. We embrace them, and we look forward to continuing to work towards that clarity and finality of that to fully enact them.
Thank you. Michael Andrew, the chairman of KPMG International, with some words on the auditors as well.
Yes, that's one of the three issues I'd raise to you. Is there's a lot done about simplistic about capital allocation, risk weighting, but I think one of the things that has not been thought through in the entire reform process is the role of intermediaries, whether it be rating agencies, prudential supervisors or auditors. I'd argue that the auditors had a very good global financial crisis for signifying the issues early on, but the question is, the global financial crisis still happened. So could you have actually done something far more differently? And we've certainly had some very constructive discussions with the Financial Stability Board, which I might expand upon on later, Adrian. The second issue that worries me is just picks up a little bit on what Michael has said. We've got to decide whether we want to be global regulators or local regulators, or at least get the balance right. Because too many times today I go to countries and see the regulators actually requiring banks or financial institutions to subsidiarise or bring their capital back into the local environment, which of course then leads to a significant contraction of liquidity, concentration of risk, and doesn't actually leverage the global balance sheets. I also see a series of domestic rules which have extraterritorial impact, which actually distorts the market in many jurisdictions in which those companies operate overseas, and I think therefore restricts lending and finance availability, particularly to small, medium-sized business. And finally, the final question, Adrian, I'd raise is the whole issue of the shadow banking system. Being based in Hong Kong and spending a lot of time in China, there's one risk in the world that worries me at the moment. It's the shadow banking system in China, and it's effectively forcing people into that system because of the regulatory environment and the lack of available capital and resources that's there at the moment. And it's one thing to layer significant regulation over the formal banking system, but there's got to be an element of making sure that we supervise what goes on in the informal sector as well.
Excellent. Thank you. Next we have Frederick Adair, Chairman of the Board of Directors and CEO of Société Générale Group. Please.
Yes, good afternoon. As the third representative of the business, the banking business, I would largely share what my colleagues Andrew, Andrey, Kostin and Michael Corbat have said. I would like to highlight three top items in my agenda when I think about our strategy going forward as a large international banking group based in Europe. One is an opportunity, and there are two worries. The first, the opportunity, is the European Banking Union. And it's a major change which will take place in the coming 12 months with, as you might know, the change of regulator for large banks like Société Générale, with a regulator which will be at a European level and close to the central bank. It's again a model which I think works. It's similar to what we have in France, which is, I think, a good model. Secondly, of course, with a transition phase that we have to manage with an assessment of the balance sheet, then the stress test, etc., to ensure that the problems have been dealt with. And then, of course, the structural function of that, beyond the regulator, resolution mechanisms, potential mutualization or solidarity between the national deposit guaranteed schemes. So as you can see, it's a big change for the banking system, but for me it's an opportunity because it's a necessary step, on one hand, of course, to further build confidence, but beyond that, to ensure that we can have a reverse trend towards fragmentation within the Eurozone and ensure that large banks like Société Générale can take advantage of the development of capital markets, for example, and much more fluid capital markets in the Eurozone. That's the opportunity. The two worries, my colleagues have touched on that already, the fragmentation which is taking place. And to a certain extent, may I say that when you think about prudential standards, to a certain extent, I had my doubt that it could be that easy to implement the same one everywhere, like the accounting. If you remember on the accounting, there was also this growl idea to have one standard everywhere. It's more or less put in the back burner. But nevertheless, this fragmentation is a bit worrying, and in particular, I would say, in a world where if you want to have growth, and here in Russia, you know, for example, in the infrastructure sector, we need funding. And if you think that it's good to be able to tap international markets, it will be very complicated, in my view, to have a fragmentation between the different regions of the world and different rules regarding these global financing needs. Basel III is a good thing from that perspective. We want, of course, to have harmonization. Let me say also that in France, banks will be in line and are in line with Basel III, and Société Générale is. And it's a given to a certain extent, and it will be good in terms of level playing field. The second worry is really this balance between regulation and capacity at the end of the day to move forward and finance the economy as a bank. And let me just say here, I'm still a bit worried. Again, as Andrey mentioned, Basel III is in itself a big change. For Société Générale, which did not change fundamentally in terms of size, business model, we reduced our balance sheet, but instead of having 25 billion euros of capital, we now have to finance, to remunerate 50 billion. We had to double the capital with less activity. It's a big structural change. If you add too much additional regulation on top of that, it makes our life very difficult, make banking activities very difficult to, again, develop, and hence perhaps put a threat on the capacity to finance the economy. So the balance is also important.
Thank you so much, and everybody is keeping to their time fantastically well. Now, Madelyn Antoncic, Vice President and Head of Treasury at the World Bank.
Thank you. Actually, I'm the treasurer of the World Bank. Thank you very much.
Sorry.
No problem. And I'm grateful to be here to be able to share my views as well. So clearly, I think in the aftermath of the 2008 crisis...
I'm finding it hard to hear. Can you speak a little bit into the microphone a bit more?
It's not on.
It's on.
It's on. Clearly in the aftermath of the 2008 banking crisis, I don't think anybody would disagree that there was need for some change in the regulation. Certainly, we needed to strengthen oversight in certain areas of, certain corners of markets. Very positive to find transparency, to find increases in disclosure, to get a safer and sounder banking system. There are a few things that I think in particular that I'm very happy to see about regulation that is sort of on the horizon, certainly with respect to some regulatory regimes, and that is a development with going towards functional approach to regulation as opposed to institutional approach. In my mind, probably one of the biggest causes of the financial crisis that we saw in 2008 was actually not a lack of regulation, but inconsistent regulation and inconsistently enforced. So you found banks, investment banks, insurance companies, hedge funds, all doing similar or even the same activities, but being regulated based on how they were incorporated, how they were chartered, and therefore that really created this big arbitrage, which really led to a lot of the destruction that we saw. So I think it's a very good, positive outcome that there are regulators looking to do functional approach to regulation. But I have a couple of concerns as well, and so I'd like to make 2 points. One of which was touched upon a little bit, and that is still there's an enormous amount of uncertainty in the world about what regulation will be. Keep in mind that regulation is just one very beginning of the aspects of the timeline along which you have to implement. So there's regulation, there's writing then the rules, there's implementing the rules, and then there's the monitoring. And Basel just came out with a study this past a month or so ago, which showed that of the 27 countries that are members of the Basel Committee, only 14 have really written all of the regulations. Of those, only 11 have written the rules, and of course, many have still not implemented. So I think there's still a long way to go, and I think the issue here is, of course, the lack of certainty with respect to what exactly is required or will be required in the future. What is then going to be the model of banking? And of course, I think this has a negative impact on the real economy to the extent that banks are uncertain and they're not sure how much capital they're going to really require or what are all the rules, I really should say. And therefore, I think it really constrains lending, which has impacts negatively on the real economy. I think the other issue that concerns me, concerns the World Bank, is the unintended consequences, and in particular on emerging markets and developing economies. And here, there are two sides of that. Firstly, from the capital requirement perspective, we've already seen deleveraging, certainly in Eastern Europe. And I think the important point, not only for emerging economies and developing economies, but also from SMEs, even from developed economies, certainly in Europe, for example, where they don't really have access to capital markets.
Yeah.
In the U.S., corporations mostly get capital through capital markets, so probably 70 to 80%. On the other hand, in Europe and in emerging markets, it's probably flipped, maybe 20% from capital markets and the rest from banks. And when banks are uncertain about all of the rules, then they pull back in terms of making loans. And in particular, when the capital charges become rather onerous and some of the rules become onerous, then of course, certainly risk-weighting assets, so if you think about it, really will discriminate against small and medium-sized enterprises and emerging economies and developing economies. So that's one concern. The other concern is on the leverage ratios, whether it's the leverage coverage ratio or the net stable funding ratio. On the leverage coverage ratio, we did see some progress with the G20 being able to be vocal and suggesting that there are issues with respect to the emerging economies, and so those issues have been resolved, but there are still issues. So one of which is the requirement for high-quality liquid assets. Many emerging market and developing economies don't have large amounts of high-quality assets to have on their balance sheets to satisfy this liquidity requirement. One reason, of course, is the one that I just mentioned. They don't have deep capital markets, and so part of the problem then becomes having to have more sovereign debt, which of course creates concentration. And I know one of the concerns that there's been, certainly even in Europe, where the concern is that banks have too large a proportion of sovereign debt on their balance sheets. Well, Basel III is actually making that an outcome. And so I think there's an unintended consequence there that has to be taken a look at. On the net stable funding ratio, developing economies, emerging markets, are pretty well heavy loan to deposit ratios, and so loans again that's penalized with Basel III rules, and I think therefore that penalizes the developing economies, and that has to be considered. These are the direct impacts of the unintended consequences. Then there's an indirect impact, and that is with respect to, again, on the liquidity ratios for developed economies, banks in developed economies. The requirement having on the net funding ratio being shorter term will really encourage banks in the developed economies to make shorter term loans. And so that, of course, hurts the developing economies in terms of infrastructure loans, because infrastructure loans obviously will hurt the requirements of the net funding, net stable funding ratio. So I think these unintended consequences really have to be taken into account when we look at all of the rules, especially when you think about the Basel Committee, which is really coming up with the rules. It's made out of 27 countries, and mostly, obviously, are the U.S., Europe, and some of the major developed markets.
Please. Kina Yudayeva, I'm sorry if I mangled your name appallingly, head of the expert department of the President of the Russian Federation for the G20 Sherpa.
Well, thank you. Well, after Minister Siluanov spoke on behalf of G20 and Andrey Kostin spoke on behalf of Business 20, I'll speak on behalf of myself. And I'll give my view as an expert on the current situation. And well, we are almost 5 years away from the crisis, almost 5 years away from the beginning we started to implement the reforms of the regulations. So it's probably the time to make some first assessments and to see what was done, what were the results with the new unintended consequences, etc.
Can you speak into the microphone or we'll lose...
What was achieved and what was not achieved. And first of all, clearly, if we look on the regulations that they were introduced, they were certainly inspired by the situation in the developed countries, and particularly in the U.S., but certainly maybe U.S. and Europe, because if we look even on the Russian environment, then many things which these regulations are concerned are underdeveloped in Russia or really not developed at all. So really the whole focus of this reform at the beginning was largely on the American and partially on the European situation. And it can only be partially implemented in other regions. So what are the results so far? We see that, well, probably securitization has gone down. We see no subprime, well, much less subprime, or no subprime anymore, etc. But we still have bubbles. And financial markets are still very unstable. And I think that from this perspective, the goal has not been reached, right? Financial market has not become much more stable because of the results. Maybe it has nothing to do with the change of the regulation. It's just we need some time to live through the consequences of the crisis. But still, we have to understand this, that these reforms so far haven't brought a more stable financial sector. At least in terms of volatility, and it brought some new what we call unintended circumstances, such as fractionalization of the economy. We clearly, at least in Russia, we clearly see that foreign banks are, well, if not downsizing, then not increasing the activity or to the extent they used to do before. And well, whether it's good or bad, in the theory before the crisis was that foreign direct investments, and they bring new technologies, they improve access to financial services. So since this is not happening to that same extent anymore, it's unclear. Let's say at least it's unclear whether this is a positive or negative effect. And as I said, we still have some bubbles. We have extraterritorial legislation and still lack of desire, I think, between regulators of different countries to really cooperate, particularly on the regulation of some of the multinational banks. There is a lot of financial protection, sometimes in a hidden way. And finally, one thing which is happening still very slowly, this is financial rebalancing. I'm an economist by education, and I believe in one of the theories of this crisis, that this crisis is a result of the global savings glut. And global savings glut is a result of the fact that Developing countries, they started to generate a lot of savings, but their financial system does not provide them with enough of safe assets to digest all those savings. So we have this significant transnational flows, and we need some financial rebalancing, significant financial rebalancing in order to have a more stable financial system. And this is not happening yet to the extent needed, as far as I understand. And we need to understand that strengthening financial regulation is probably not enough to fully stabilize financial system. We need also some financial development in order to make it more stable, particularly in the regions where it is underdeveloped. Thank you.
And now Thomson, the Minister of Finance for Singapore.
Thank you. Let me make three broad points. First, I think the great complexity of the situation we face, as reflected in many of the comments that we've just heard, is the fact that we are trying to prevent the next crisis at a time that we haven't yet gotten out of the last crisis. We're trying to insure against the next crisis at a time when we are still far away from normal growth in the advanced economies, far away from a reasonable level of health in our banking systems, quite far away from... Is this on? Yeah. So we're quite far away from normality coming out of the last crisis, but we know we also have to start preparing the system, strengthening the system to avert the next crisis. And I think it requires a lot of clarity because of this complexity of two challenges at the same time. It requires a lot of clarity on priorities, on instruments, and on sequencing or timing. Absolutely. We are, in my opinion, in danger of focusing too much on preventing the next crisis by imposing layers of regulation, principally capital charges and liquidity requirements, which make a lot of sense when you look at them in their own right, when you try and think about how we can prevent the next crisis, but are suboptimal given the conjuncture that we are in, given the situation we are in today. Now, what are the alternatives? I think the main alternative that requires a lot more emphasis is to emphasize supervision more than regulation. Clearly, banks needed more capital, and banks in Europe are still significantly undercapitalized. Clearly, there was a need for better liquidity buffers. But we need a lot more emphasis on supervision, ongoing, intrusive supervision, with more supervision for the systemically important institutions, because it's a lot more growth-friendly. The banks don't have to pay as high an insurance premium through supervision compared to regulation. That's my first point. Second point is that I think we are focusing a bit too much on structure of banks, whether it's the Vickers report in the UK or Volcker report in the US or Liikanen in Europe. We are focusing too much on structure, and we're taking too much of a national perspective as we design these new structural proposals. First, we have a problem because we're not going to be able to get harmonization between these different structural proposals, but the same global institutions are going to be subjected to at least three different structural proposals. For instance, if you talk about a British bank, it'll mean they're subjected to Vickers and Liikanen, but plus more if they're operating in the United States. It'll greatly complicate supervision, quite apart from imposing regulatory costs and uncertainties. Second, to take Madelyn's point, bear in mind that a large part of the world comprises systems which are still very dependent on banks and which need to develop capital markets. Certainly Asia and the emerging markets generally, the real priority is to develop capital markets. And frankly, large, globally diversified institutions, what we call global SIFIs, are critical players in making markets in the emerging markets. They're critical players in providing liquidity, taking the other side of the bet, and being able to allow for hedging markets to develop. So a large part of the world, and particularly a part of the world that's going to provide future growth, is going to require large, globally diversified institutions. And I think that international perspective is extremely important when we think through structural proposals. Further, to take another point that was made briefly, if we think shadow banking is going to be a little messy and something that we're going to have difficulty getting our hands around in a national system, just think about what shadow banking will be internationally. And if we overdo our structural proposals, slicing retail banking away from market businesses, we are going to accentuate the problem of shadow banking globally, and it's going to be extremely hard to regulate, let alone supervise. Final point, let's think about the longer-term challenges facing finance, the mega shifts. We do not yet have the institutions and instruments that will cater well to the large pool of aging savers in the advanced or mature nations. Savers are getting older. They need yield for their retirement savings, but they can't take too much risk, and they need some liquidity. But with regard to the use of funds, there's tremendous demand for long-term investments. There's tremendous demand for infrastructural finance, but it is longer term and it is higher risk. And we now have a mismatch globally as well as in national and regional financial systems. A mismatch between the needs of the largest pool of savers in the world who are still in the mature economies, who will increasingly want some decent yield, but without too much risk and without too much illiquidity. A mismatch between that and the needs of the underlying real economies that are going to generate the bulk of global growth, which is the need for long-term finance, which means new instruments, new intermediaries, and much stronger capital markets. Thank you.
Chrystia Freeland from Reuters.
Okay, well, I'm a journalist, not a finance minister or the CEO of a leading bank, so I'll just
Perfect qualification.
Yes, exactly. So I'll just comment very briefly on maybe what seemed to me to be the key themes that people have raised already. The first one, and it seems to me the dominant issue that we've all been talking about is this mismatch between a world in which capital and business is global, but political authorities are national. And that's why I think the point made about this danger of fragmentation is absolutely correct, but that's why it's going to be a really, really hard problem. There's not going to be an easy solution to it. And I think we're just at the beginning of incredible tensions being felt on precisely that fault line. The hope that we heard about Europe coming together on banking it's not an accident that that's happening in Europe, because Europe, with tremendous pain, is starting also to consolidate its political authority. And that's why it's able to consolidate its financial regulation. But I don't think that it's because, regulators are stupid or bankers are pig-headed that you're unable to make these two things match up. There's just a fundamental mismatch happening in the global political economy there. And one level of that, which was also reflected in our conversation, is the mismatch between how the economy works in the developed economies and in the emerging markets. And so when you put those things together, capital being global, government being national, and national governments and economies operating in very different spaces, you can understand why this is terrifyingly complicated. A second big issue that I think Tharman especially touched on, and probably the bankers were too polite to touch on, is all of this is insanely complicated, and we, as a world, are expecting the work to be done by government regulators at a time when national budgets are under tremendous pressure and the ability to pay those regulators is not that great. So, you're asking people to take on this tremendously difficult, complicated, politically often unrewarding task at a time when the budgets to support those institutions are probably shrinking. And by the way, the entities that you're regulating are pretty rich by comparison. So I think that's another really big fault line that has been alluded to a little bit in our conversation, and is another reason why this is a fiendishly complicated problem. And then just a third point, a lot of us have been talking about how this set of issues, the financial regulation, reforming finance, is backward looking. It's about responding to 2008, And people have reflected on the fact that actually in some ways in 2013, the more urgent problem is growth. I think that's absolutely right. And I would just point to what it looks to me from the perspective of a journalist as a new set of thorny problems that are going to be thrown up, thorny political problems that are already being thrown up in the financial sector. And that is this whole issue of global taxation, particularly including the issue of tax havens. And I think that's the latest place where we're becoming aware that this mismatch between global capital and national governments is really starting to get a lot of citizens angry, and is starting, frankly, to strain the budgets of a lot of national economies. So I predict, and there are some of the organizers of the St. Petersburg Forum are here, I predict in 2014 there will be a panel focusing specifically on that you should all speak on.
Yeah, I wanted to pick up on Chrystia's point about tax havens and taxation, global taxation in general, and ask Minister Silyanov. The G8 has just concluded with some very vigorous talk about clamping down on offshore financial sectors and offshore financial centres. Is this something that's going to be carried forward in the next few months, or was it just populism, just show? Is this the next big item on the agenda, the tax havens, Minister?
No doubt, the question of transparency, openness in terms of the beneficiaries of some companies is an important issue. Is one of the issues related to transparency on the market, since Russia is facing this as an important problem, as a formidable problem, just as many other countries. And today, so far, we are moving towards concluding bilateral agreements with the United States and with a number of other countries, and Russia has been a party, was involved in preparation for such an agreement, and will probably conclude it until end of this year. But I think what we should talk about right now about a comprehensive agreement under the edges of OECD, perhaps, probably revealing the end beneficiaries of companies, so that everybody could understand and could see the actual activities of these companies, which is related not only to tax dodging, but also to better understanding of the capital structure and the sustainability of the company. If we know the end beneficiary, if we know this company works with other companies, with stakeholders, everything has an impact on the company's stability. That is why the Russian Federation, and let me tell you that, and all negotiations on international level will pay an increasing attention to this issue. That is why we in Russia have prepared a series of legislative acts, initiatives to increase the transparency of the companies, especially those acting in non-transparent jurisdictions. And we've also offered a number of measures regarding tax dodging and tax avoidance and increasing the stability of such companies. So I think we will increase efforts, we will strengthen our work in this area, and it should be coordinated on international level.
Mr. Kostin has also asked to speak on that, and I'd like him to speak on that, but I'd also like to ask him a subsidiary question, which is that he talked about the disconnect between the banking sector on the one hand and the real economy on the other, and how small and medium-sized businesses are finding it very hard to get money, even though there's so much money sloshing around. And I'd like him to address that question as well, but first on the tax havens.
On tax havens, I think within the next couple of years they'll be rather dead than alive. I think the winds coming from America, from Germany, even from Russia now, means that the tax haven soon cease to exist. I mean, at least as a haven for taxes, maybe for some legislation point of view, we just discussed this issue with the Russian government. You know, there's some more advanced legislation in Cyprus, for example, than in Russia for the companies. But otherwise, I'm afraid, or I like to say that probably they will be useless. So I'm very strongly recommend those who are present in the audience to move your money away to St. Petersburg, to VTB office or Citigroup office or Societe Generale's Rosbank offices. They're all present here. It is safe and nice from the tax point of view, Russia. On a second issue, well, I think that of course, first of all, we have to say that in order to borrow money, SMEs should have business to do. And that's a very big question for Russia, for example, maybe as well as other economies. How to actually introduce more SMEs whose activity are in demand. Because in Russia they're playing still a very limited role in other sectors than some kind of services, for example. So, but on the other hand, I agree that they are first to suffer when something happens in the global economy, and one of the reasons is the lack of funding. But I'm afraid here, we'll discuss this morning, there's no alternative, is to provide some kind of the comfort for the banks, for their risk management, by having some kind of the support from the governments, either from the local governments or from some government institutions, which do exist in many countries. And secondly, maybe to have some easy access to refinancing through the central bank's mechanism, funding for this. But definitely that is a risk area for all the banks, more risky than lending money to large corporations, in many cases, not always. So this risk should be reduced if we want to provide adequate level of lending to SMEs and at a reasonable price. So there's no other way, as I think, that's to provide some kind of the government guarantee to enlarge this mechanism. In Russia, for example, that's mainly lies with the local government as well the Bank of Development. In other countries, in France, I know there's other organizations all around the world. And I think that's, if we put attention to this particular area, I know that we even discussed the idea of central banks providing a special refinancing facilities, though of course we know that Russian Central Bank, for example, is completely against the separating different kind of liquidity for depending on the purposes. They provide just liquidity for the banking sector, no matter whether it's SMEs or large enterprises or financial market operation. Thank you.
And that's it's also a huge subject, I should say, in Great Britain. I'm going to ask Madelyn to talk just for briefly, then I'm going to move on to a different subject.
Thank you. Thank you. I just wanted to add to, one comment about the issue of the SMEs. And I think here's another example of an unintended consequence, and that is with respect to securitization. And if I heard correctly, your comment about securitization is down, and that's a good thing. It's not so clear to me that that's necessarily a good thing. Securitization has been around, at least in the States, since the early 1980s, so we're talking 30 years. And securitization has been an effective way of getting money to companies and others who might need the access to credit, who otherwise would not be able to get that credit. And at the end of the day, I think the problem was it had always been a means to an end, and then with all of the regulatory arbitrage that I talked about a minute ago, it really ended up becoming an end in and of itself. And so I think we really need to be careful with regulation not to throw out the baby with the bathwater. So SMEs clearly could benefit if regulators would allow the banks and relax a little bit the whole issue with respect to securitization, because at the end of the day, if a bank is not going to be able to get loans that it's making, assets off the balance sheet, and especially to my point before, if they're longer term loans in particular, because you've got two issues, not only the capital and the risk weighting charges, and so of course SMEs are going to have higher risk weighting charges, but also with respect to the net stable funding ratio. And so there's a disincentive in both cases, and so to allow them to securitize, get it off the balance sheet, I think would be much more productive in terms of economic growth.
This is a question for Michael Andrew first, then for anybody else who wants to answer it. The Chinese shadow banking sector, how big a problem is it? How big a problem for the rest of the world economy outside China is it? And what can be done about it?
I think it's a very, very significant problem. I think there's a real bubble there where small to medium enterprises in China have not been able to access the formal banking system, a result of which there are a lot of loans which are simply outside prudential supervision, have been done on very speculative assets, and I think at some stage there's going to be a day of reckoning coming, in which
Do you think
case...
it's a bubble that might burst?
Well, I think if there's any bubbles around the world at the moment, this is the one that troubles me most, that may well burst. Now, do I think that's going to implode the Chinese banking system? Absolutely not. I think the major formal banking systems are well provided, well capitalised, and they'll cope. But I think there's got to be a situation where, as part of the economic reform package that's announced in October this year, the Chinese government really does tackle this huge sector of the economy, which to me is completely in contradiction with what we would call normal commercial banking practice.
And do you see any signs that they might want to be willing to tackle it?
I think they need to tackle it. I think they know they need to tackle it. And I think now you've got some very experienced bankers in the finance stream and the prudential supervision stream. You're going to see some action there.
Could I just make a comment
Yes,
to that?
please.
Clearly, it's an issue, and the IMF just came out with a study in April showing that of the $2.4 trillion of new debt in the Chinese market in 2012, 40% came from shadow banking. And but again, clearly the regulators now see the problem, and in fact, just this week, I believe they announced that asset managers, for example, the trusts, which is where a lot of this money is coming from, are going to be limited to capping their loans that they on-lend to 30% of their assets. So they recognize it's an issue, and I think they're trying to do something about it. But I think to Tharman's point about, really kind of fighting the last war and not really looking forward, this really strikes me as a little bit unusual that I believe there's an issue with shadow banking, but again, throwing out the baby with the bathwater is not prudent. And if you think back, at least from the U.S., and maybe some people in the audience may not be familiar, but I recall very vividly when I was an economist at the Fed, where the big concern back in the mid-'80s was the money market mutual funds, and they were considered a shadow bank. And the big concern there was that they really were hurting the monetary transition mechanism, and because the Fed wasn't able to really control money supply anymore, because how did you define money when you had all of these mutual funds and money market accounts? And so I guess no one can really imagine today without having money market mutual funds and other kinds of savings accounts that can be used as money and as cash. So I think for us to just say no shadow banking and no putting such a bad connotation about it really is not the most prudent way forward. I think we need to figure out how to deal with it, how to regulate it, and how to be prudent about it, but not just to totally think about shutting down, because at the end of the day, again, access to capital is what's important. So develop capital markets, develop an alternative that's economically efficient and beneficial, and I think you'll see there be an equilibration.
This is a question for Frederick O'Dea. I feel as a patriotic Englishman, I would be not doing my duty if I didn't ask him this. But isn't there a danger that trying to combat the fragmentation of the financial system, for example, in Europe, that you actually will do more to actually promote fragmentation, that trying to impose a one-size-fits-all policy, you will actually encourage some people to exit the system and make the system more difficult to sustain?
At a European level, I don't think so. What is happening today is a problem, if you wish. This fragmentation of a single currency market, where euros in one country do not go easily to finance credit in another one, where you have, as you know, regarding SME financing, in particular in Spain and Italy, a problem because the cost of credit and the access of credit is difficult. I think it's very difficult to imagine that it makes sense or it would be efficient to carry on like this. So really at a Eurozone level where we share the same currency and where the idea was to have a single market with efficiency, I mean with savings being able again to, in an optimal way, finance the economy, it's absolutely needed. And on top of that, beyond that, when I think about Europe and effectively trying to turn the page of the crisis, there are two objectives, two strategic objectives. Build a strong European banking system which will be able to compete internationally and of course play its role to finance, for example, emerging markets economy, provide funds either for balance sheet or, of course, with capital market structures with savings in Europe, and trying to deal with this mismatch that Minister Shammu-Garatanam was mentioning, of course. And the second one is building also capital markets, because in Europe we have a very difficult transition to manage, which is, as also was said, to move from a system where the banks were financing the economy to a much more balanced system with more capital markets, a more Anglo-Saxon one. You cannot do like this in a quarter. You have to move progressively because investors have to be comfortable with these categories of assets. And so there is a transition phase, and it's a complex one. And we need, of course, then strong capital market structure to ensure that we have also the infrastructure to do this transition. So it's absolutely needed to take from that perspective a European view, a Eurozone view at least, rather than having each country trying to deal on these topics on its own. That, for me, it's a given.
I'd like to bring the audience in now. Is anybody out there wanting to ask a question? I'm afraid we've got 5 minutes left. We're very pressed for time, but nobody? Then I'm going to ask Mr. Tharman about his emphasis on supervising rather than regulation. What exactly does that mean? And is it just a bit woolly? You know, is it a cop-out? That's what I'm trying to say.
First, regulation comprises capital charges. It comprises requirements for liquidity. It comprises some concentration limits that regulators place on banks especially. Supervision is ongoing. It's where there's a constant presence of a supervisor, sometimes within large institutions. It's constant interaction at different levels of management, including the board all the way down. And it's constant reporting particularly of the information that supervisors require by way of stress tests. There's a whole set of instruments at play here, but it's continuous. It doesn't pretend to be perfect, but it's not very costly. One of the reasons why I think we haven't placed enough emphasis on supervision post-crisis is that there's been a little too much of a desire to make it seem as if all of the problem was that banks were undercapitalized or banks made mistakes. Actually, everyone made a mistake. Supervisors were caught blind on many issues, and I think it just requires a lot of humility on everyone's part. Bank boards and management, supervisors, and the markets themselves, credit rating agencies and the markets. Everyone was blind to certain risks and the build-up of concentration risks. Everyone was blind to what was going on in the shadow banking system. But these are not problems which are impossible to tackle with some degree of assurance. It's not going to be perfect. So the search for perfection in capital rules and structural, the restructuring of banking by taking retail out from market businesses and so on, is, I fear, going to be the enemy of the good. Supervision doesn't pretend to be perfect. It's a constant exchange, and the supervision that I was tutored in when I was a bank regulator about 15 years ago was actually old-style Fed and State Department of the New York state banking supervisors who just regularly went into banks, poured through their books, engaged in conversations with every level of management. It was intrusive, but it was the way in which you ensured information was passing between all sides all the time. And I think we lost sight of the importance of regular supervision and regular exchange between supervisor and bank.
Right. We have a couple of minutes left. I just wanted to ask Michael Corbat a question, which is there seems to be a general consensus that we need deeper, better, richer capital markets in Europe, Britain, Russia, and that the Anglo-Saxon model, particularly, which is really the American model, is admirable in that sense. What can we do? How can we learn from you on capital markets?
Well, I won't be presumptive to believe that there's a lot of learning to do, but I think you can look at a couple statistics and a couple things that have happened. So first, something that's happened is one is that there has to be a recognition in the financial space today that many banks' costs of funds are in fact higher than that of its customers' access to the capital markets. And so why does it make sense for bank balance sheets to be saddled with loans to clients when that very client has access to the capital markets at a cheaper level? There's crowding out that occurs. If you look at some statistics or some numbers in the U.S. today, there's approximately somewhere around $8 trillion of corporate borrowing. Roughly 20% of that borrowing sits on bank balance sheets. If I compare that against Europe today, in a pan-regional basis, there's roughly the same amount of borrowing in the corporate space, but 70% of that sits on bank balance sheets that potentially crowd out accessed by certain segments of either individual or the corporate population to those balance sheets. I think the good news is today that financial borrowing, as banks have delevered, has come way down. I think as you look at the search for yield and the search for assets, I think that's allowed the capital markets to expand. And you saw just in the first half of this year, probably largely rate and liquidity driven, but as robust of a calendar as probably we've ever seen. And so I think we need to continue to push forward and to push the edges, and I concur that we do need a healthy, functioning securitization market. Whether that's in the U.S. or in Europe, we've got to get that, and we've got to give people access to those monies. But we need to continue to push the boundaries. We need to encourage our small and medium enterprises to get ratings, because without them, they're disadvantaged under Basel III. And I think they'll see a warm and hearty welcome from the capital markets as they try and do that.
Well, I think we've heard this afternoon from a very distinguished and also a very diverse panel, lots of different voices and lots of different perspectives. I'd like to thank you all very much indeed for taking part in this panel.